Great, thank you so much, and good morning all. Thank you so much for joining our rescheduled webcast. As you can imagine, in these unprecedented times, we've witnessed a massive surge in virtual events everywhere, which is placing stress on the platforms used to deploy these programs. After the complications we experienced last week, we've chosen to use a different technology platform for today's program. If you experience any challenges, please let us know via the Q&A feature on the webcast console so that one of our specialists can help you. We really appreciate your patience as we navigate this new normal. Now, let's focus on our main topic of how family offices can approach tax planning in light of COVID-19. We're going to spend the next 90 minutes covering a variety of topics, as you can see here on the next slide, including individual and gift and estate planning, philanthropy, various payroll credit opportunities, and a technology platform that can help family offices who are now navigating a remote workforce while maintaining the confidentiality of the family members' data. Over the next few months, we will be delivering additional content through webcasts and written alerts focused on family offices as changes occur, and we would truly appreciate your feedback throughout these webcasts or at the end of the webcast on other topics that you feel are relevant to you that you would like to hear more about. With that, I will turn it over to Jeff Coomer, a Managing Director in our Washington National Tax Practice Tax Policy Group, to provide a short overview of the journey we've been on and what could be next in a Phase 4 bill. Jeff?
Thank you, Wendy. Excuse me. I appreciate the opportunity this morning to present on this webcast. Certainly, Congress has been busy. The administration has been busy over the course of the last month, and you see this in the form of orders of magnitude. So 3 legislative efforts signed into law, approved by Congress on a bipartisan basis, going back to early March, starting with really just trying to fund government agencies with a little bit of additional money in order to start to combat and think in terms of what the COVID-19 pandemic might look like. That morphing really into the second legislative effort, the Family First Act, which mandates primarily businesses that don't already offer sick or family medical leave to mandate to provide those leaves, but then offers refundable credits to offset a portion of those. And I think, Grace, there's been a lot of questions on the employment side that you will get into perhaps later related to that. But that was sort of the second legislative effort. And then really kind of moving into the third legislative effort with the next slide, a $2.2 trillion economic stimulus spending package. There's a number of provisions on the individual side as we start to get into this. You know, there's limits on AGI for taxpayers who might qualify for these direct payments back to individuals. But as you can see, they're starting to try to put money into folk pockets who otherwise have been furloughed or who may have lost their job in the near term here. Other individual provisions, there was a loss provision, excess loss limitation put into place back as part of TCJA. That has now been suspended through the end of 2020, and you'll see that as a consistent theme with a number of these provisions where they have been effectively suspended, as in not in place through the end of this year. There's changes around charitable contributions, including on the individual side, just an above-the-line deduction essentially available for everyone. If you don't otherwise now itemize, you can take $300 on that. Moving into retirement provisions, again, really just trying to provide additional access to funds that you have in place there, and suspending the required minimum distribution rules. We go back to the Secure Act back in December, where they increased the age from age 70 and a half to age 72. This just suspends that for those distributions that are due in 2020. So some things there on the individual side and on the retirement side, but bigger individual side, there are AGI limitations. So really limiting the folks on the income side who would be able to receive those checks. There's also a number of business provisions that are in there as well, thinking in terms of operating a family office as well as operating businesses within the family. And you know, this is where a bulk of the tax dollars really went as part of the stimulus legislation. So a $2.2 trillion bill But about $590 billion of that is really in tax side of the equation. A number of provisions here on the business side, net operating loss carrybacks. This really allows you to look at losses that you have in 18, 19, and 20, and then temporarily carry those back up to 5 years. So that is a provision a lot of folks on the business side are looking at. There's that, the interest deductibility limitation that was set at 30% in TCJA. That is increased to 50% now, again, through the remainder of this year. For folks that have 53E AMT credits that are remaining out there, remember the corporate AMT was repealed in TCJA. It allows you to effectively accelerate those credits that you might have taken into account in latter years. It allows you to accelerate those into this year. One provision that is a technical fix to TCJA, something that is one of those technical corrections that we have been waiting for action on since the end of 2017, is that qualified improvement property. So to the extent in your office there, if you've made renovations or if you had investments in retail or restaurant, it's those leasehold improvements that maybe you've made. Now is an opportunity, because this goes retroactive back to 2017. It goes retroactive back to date of enactment. So this now allows you, if you've filed a return in 18, for example, to go back and file perhaps for an amended return to claim cash on that. Or if you are thinking in terms of a 19 return, maybe it's an accounting method change, but here's an opportunity that they put in place to finally fix that drafting error and to claim cash in the near term. There's a couple of employer-related provisions that I know Grace will get into a little bit more detail, but there's employer deferral of your payroll tax contribution, so that's at 6.2% employer payroll tax. Now through the remainder of this year, you can defer that with 50% due at the end of 2021 and 50% due at the end of 2022. So it's not payroll tax relief, it's a deferral, but again, it allows you to think about that 6.2% on employee payroll that you can now allocate potentially elsewhere. And then there is an employee retention credit, which is potentially available to certain employers who either fully or partially suspend operations due to a government order, like a shelter-in-place order, for example, or sustain significant decline in gross receipts year over year. And I think there's a lot of questions that maybe Grace will delve into later related to the eligibility of this, but it is worth looking into. I know one question that we are getting, and certainly Deloitte is not in the business of offering legal advice, but there's questions around the interchangeability between the employee retention credit and the SBA payback check program, the PPP, and the issue there being that if you do take advantage of an SBA loan and then ask for either partial or full forgiveness of that loan, then you can't then qualify for the retention tax credit. And one thing that may be of interest on the SBA loan, just to kind of remember and pay attention to, and when you pointed this out to me, and I went in and looked at the form specifically, but the Paycheck Protection Program loan application, it does specifically have language in there related to freedom of information. So down the road, potentially, if you ask for, qualify, and receive funds from that loan, just keep in mind that somewhere down the road, someone could start to dig into a FOIA request to start to ask specifically for who actually managed to get loans under that loan program. It actually came up on a call that I was on earlier this morning with an investment firm that works with family offices as well. So this is something that folks are thinking about. Just something to take into account when you're sort of modeling out and doing the exercise to determine whether it's better to look at the loan or look at the employee retention credit. Finally, I have one last slide here to start thinking about what is next. Again, we've moved through kind of 3 phases of this. I think early on, right after enactment of the CARES Act, the talk was we're going to move to a phase 4 and what that might look like in the future. I think what we're seeing now is particularly related to the SBA loan program, where that $349 billion is already effectively oversubscribed, that there's a near-term legislative effort that is already underway to try to put more money into that account. In fact, the Senate moved this morning, even though the House and Senate are out of session, Majority Leader Mitch McConnell moved with a unanimous consent agreement request this morning to add $251 billion more to that program, to top off at $600 billion. It was denied. Senator Chris Holland, Democratic floor leader, came down and did not agree to that unanimous consent agreement because there are some Democratic asks about $150 billion for state and local government direct injections in funds, as well as $100 billion to be added on the hospital funding side. But you see here that conceivably in the next week or so, or 2 weeks, we could see an additional $500 billion or so going into, to really kind of shore up programs under the CARES Act and maybe plug a few sort of holes or technical glitches that are already arising related to the CARES Act. So that might be called sort of stimulus phase 3.5. And then you start reframing what a future phase 4 looks like, and that may be later in the summer, it could be in the fall, or as we have seen, it could be as early as late May, even June timeline. And what that might look like: additional funding for unemployment, maybe another round of direct payments to individuals. If phase 4 gets to be into the fall, maybe tax provisions start to look more like extending those provisions from the CARE Act beyond the end of this year, because most of those are tied to the end of 2020. So maybe excess business loss provisions under 461L get extended beyond the end of this year, or employer payroll contributions get deferred for another 6 months into next year. We might see tax play a larger role later in the year in a stimulus effort, but in the near term, I think you're going to see it more focused on sort of topping off those loan accounts and putting additional spending into hospitals and as well as state and local governments just to continue to sort of fight that and provide cash liquidity to fight the pandemic in the near term. So we'll see how this plays out. It is very fluid, obviously. I would anticipate we might be having a webcast in the future where we can talk about that further. But in the meantime, why don't I turn it over to Wendy for our first polling question?
Perfect. Thank you, Jeff. So the first question here: what provision in the CARES Act is most relevant to your family office or the family members and businesses they own? Got a couple choices here. And just as a reminder, if you have any problems with the polling question, don't worry. As long as you're on the webcast, we'll be able to capture that for CPE certificates. Jeff, you noted that, the next round, phase 4, may not have a significant number of tax provisions as the CARES Act did. What are some of the provisions you're hearing most that could be related to tax, and what could be some of the conflicts we see around those?
Yeah, certainly. I think, again, it's probably a continuation of those provisions that are already in the CARES Act, as opposed to adding new business ideas to the table. But I think, the 50% limit on interest deductibility, I think that, that's a candidate that could get pushed out a little bit further. Net operating loss, maybe they, try to add 2021 to the years 18, 19, and 20 to that as well. But as far as new starters, that's a very good question as to, how much we'll look into new provisions that again, are really designed to try to increase cash flow right now. That's the whole goal here, right? It's not to think in long-term fixes to TCJA or other things. It's what can we do to put cash into pockets of employers in the near term. And the other thing to think about is that there's already going to be challenges to the CARES Act that need to be addressed that weren't addressed in the statute. One of them being, for example, looking at what is a declared disaster area for purposes of tax under 165. There's some question. It's easier when your buildings are destroyed, your office structure is destroyed in a natural disaster. This is different. So do the current set of rules under 165 really apply? to what a disaster is, or do those have to be amended in some way to provide some employee relief on that side? So I think there's going to be, that's just one example of what I think will be a number of issues that arise that have to be addressed simply because the statute to the CARES Act was moved through so quickly.
Great, that's very helpful. Maggie, do you want to share the results? Okay, well, we'll keep going forward. I want to turn it over, keep us on track here with Eddie Gershman, Managing Director who leads our individual income tax group within the Washington National Tax Practice. Eddie?
Thanks, Wendy. Hello, everybody. Thanks for taking the time to join us today. So I'm going to go through a couple of topics. First, I'm going to talk about the relief that's been offered with respect to filings and tax payments. So let's go to my first slide. And just by way of background, we saw over a period of about a week 3 different IRS notices and about 20 plus frequently asked questions that were all built on one another or clarified prior guidance in the chain of communication. And all of these communications related to the limited relief that was being provided for returns and payments due. So we're going to talk just about that for a minute. The first question is, who in fact does this limited relief apply to? And you'll see in the third and the fifth bullet points, I think, are the relevant items. In the third bullet point, you'll see that any person, and that includes an individual, a trust, an estate, as well as the other entities that are listed in that parenthetical. So any person with a federal income tax payment or income tax return that's due on April the 15th is an affected taxpayer. And then in the last bullet point, you'll see where that was expanded to include that any person with a federal gift tax and generation skipping transfer tax payment due or a requirement to file a gift tax return is also an affected taxpayer. So with that, let's go to the next slide and see what the limited relief is that was offered to affected taxpayers. So again, what's the relief? In the first point, you'll see that affected taxpayers have the due date for their federal income tax payments, and that includes payments of tax on self-employment income, net investment income tax. It would also include if you have transition tax under 965H, all of those payments which are due on April the 15th of 2020 are automatically postponed until July the 15th of 2020, and the returns associated with them are postponed until July the 15th of 2020, automatically. The due date for federal estimated income tax payments on those same liabilities that would be due on April the 15th of 2020 for an affected taxpayer, again, an individual trust or estate, is also automatically postponed until July the 15th of this year. And what do you have to do in order to obtain this relief? You don't have to do anything. Affected taxpayers don't have to file an extension. It's automatically provided to them by postponing the due date. And there's also no limitation on the amount of payment that can be postponed. The initial set of draft guidance had a cap associated with that. That was not part of the final legislation. So there's no limitation on the amount of payment that might be that can be postponed. And then what if you need more time to file the returns after July the 15th of 2020? You just need to go ahead and file the appropriate extension forms by July the 15th of 2020. So for an individual, that would be a Form 4868, and that would provide an extension to the original extended due date. So it would go out to October the 15th of this year for individuals. Trusts would be September the 30th of this year. Let's take a look at the next slide and just talk briefly about if you have 990Ts for unrelated business taxable income. I know some of you may have that, so we'll just cover this pretty quickly. So with respect to the Form 990T, if that form is due to be filed on April the 15th of 2020, then its filing date has also been automatically postponed until July the 15th, and the requisite tax associated with that too. But for taxpayers whose 990T would actually be due on May the 15th, which can be the case, that due date has not been postponed under the guidance that's been offered so far. So that would be due, the return and the tax at this time. And then you'll see at the bottom of the slide, for federal income tax returns and payments due on any date other than April the 15th, the notice does not postpone those returns or payments. Okay? On the next slide, let's just go a little bit deeper with respect to gift tax returns. So this is a summary basically of I think it was the third notice that came out, 2020-20, addressing gift tax returns. And again, for affected taxpayers, as we said earlier, the due date for filing their gift tax return and making payments of federal gift and generation skipping transfer tax that would arise from a gift tax return that's due on April the 15th is automatically postponed until July the 15th. But you do need to note that this limited relief does not extend to generation skipping transfer tax that could arise from a GST taxable distribution or a GST taxable termination. This relief does not provide postponement for those liabilities. Affected taxpayers do not have to file any formal extension to obtain the relief. It's automatically provided. But if they do need to obtain additional time to file their gift tax return, you would need to go ahead and file the requisite extension forms by July the 15th, and then that would provide you an extension until October the 15th. Okay, so on the next slide, let's just talk a little bit about what we know for how the IRS is going to address interest and penalties with respect to this. So as a result of the postponement of the due date for federal tax returns, federal income tax returns, and making the federal income tax payments from April the 15th until July the 15th, that period beginning on April the 15th and ending on July the 15th is just going to be completely disregarded with respect to the calculation of interest, penalty, or addition of tax for failure to file the income tax return or to pay the federal income taxes postponed by these notices, okay? And then logically, interest, penalties, in addition to tax with respect to those postponed amounts would begin to accrue again on July the 16th. There is an FAQ, it's FAQ number 24, and that indicates that interest will not be suspended for any underpayment of estimated taxes which were required to be paid prior to April the 15th of 2020. And our interpretation of that is in the example there. It says, so for example, if a taxpayer owed but didn't make a payment of $1 million for their fourth quarter estimated tax payments that was due on January the 15th of 2020, interest would actually continue to accrue on that underpayment until paid because it was due January the 15th, not due on April the 15th. And the FAQ 24 suggests that interest will not stop accruing with respect to that. So, you know, I've referred to this, I know I've gone through this pretty quickly, I've referred to this as limited relief. Let's just take a look on the next slide and talk about where relief is actually not provided. So, you know, if you happen to file any of the forms here, no relief is provided related to the filing of the return. So your 706 series that I had talked about before with respect to generation skipping taxes, if you file a 3520, no relief is provided with respect to that. Split interest trust and income tax returns on Form 5227, the 1040A that's mentioned there, as well as your foundation returns, 990PF and 990s. Those are not covered in this series of relief. So no relief is provided with respect to these returns that are summarized here. Okay, so let's just go ahead and wrap up this topic on the next slide, just with a couple of final considerations. So the most important point, I guess maybe the 2 points I'd like to make are in the middle of the slide. And that's the second point, indicating at this time, no relief is provided for estimated tax payments that are due on any date other than April the 15th of 2020. So your second quarter payment, if you're making estimates, would be due June the 15th. That's not extended under this notice or this series of notices. And I know that's weird because we just talked about how your first quarter payment that's due April the 15th is postponed until July the 15th. Your second quarter payment is actually due before the first quarter payment because it's not automatically postponed. And then, you know, the third point we mentioned here is just in general, our recommendation is to follow the notice and the series of notices. And that's just because from our perspective, to the extent you can go ahead and follow the notices, you're just more likely to navigate your way through this sort of seamlessly without getting any correspondence from the government, things of that nature. So, you know, following the guidance that's been provided, I think is good advice to heed. So, Wendy, I think I'm going to shift gears back to you for a poll before we get into our next topic.
Yep, so our next polling question is going to pop up. It's true or false question. No separate extension is required for foreign information returns, such as a 5471, an 8865, a 926, 8621, that are filed as an attachment to an income tax return, which has been postponed under Section 7508A. Eddie, we've had a number of clients asking, you know, frequently when we don't have this deferred date to July 15th, which is unprecedented. Payments are due on 4/15, and oftentimes included with an extension payment is a first or second quarter estimated tax payment, and then there's just a greater overpayment applied to the, call it 2020 tax year. Can you talk about the interplay if those extension payments are now not due until July 15th? Could taxpayers do the same thing?
Yeah, I would, so the way I would look at it is maybe twofold. So one, your extension payments due April the 15th, and your first quarter payment is due April the 15th, and both of those are postponed until July the 15th. So from our perspective, making your payments to cover those liabilities in July is fine. I would say we've been asked the question a bunch, well, can I actually goose up the payment even further and maybe cover my second quarter payment, right? Because that has given some people the impression that they would be able to manage their way through the postponement and leverage the second quarter payment further. We don't believe it works that way, and that's because of the comment that I made earlier about no payments other than those due on April the 15th are postponed. So your June the 15th payment, second quarter payment is due June the 15th, and we think if you actually goosed up your extension payment to cover the balance due first quarter and second quarter, right, the amount that you would apply to the second quarter would actually be credited as being paid on July the 15th. With it being due on June the 15th, you would be subject to some underpayment penalties, which actually is going to be our next topic that we'll talk about after this. So covering your balance due in your first quarter in July, fine. But I think if you look to go beyond that, at least as of today, it doesn't work. You can't cover your second quarter payment timely in that, under that approach.
Got it. Okay, thank you. Can we try and present? Here we go. That's right. No separate extensions required for these foreign forms. Okay, so we're gonna keep moving. Eddie, let's talk about some of the methods for computing estimated payments, and then we'll dive into some of the specific CARES provisions and how it could impact the family members or trusts that are the family offices are serving.
Yep, thanks, Wendy. So we're going to shift gears a little bit and talk about, as Wendy had said, estimated tax payments. And we just thought it would be appropriate, given that many of our clients, many of you often pay their estimated income taxes based on their prior year tax liability. But now they may not want to, given the potential decline in income tax liability that could be occurring between 2019 and 2020. So we thought it would just be appropriate to go through at a high level, how to determine your estimated tax payments and some things to consider. So just briefly on this slide, individuals are subject to an underpayment penalty unless their total withholding and timely estimated payments equal the smaller of 90% of the tax shown on your current year return. We refer to that as the current year approach, okay? Or 110%. It could be 100% if your adjusted gross income is below a certain threshold, but let's just assume it's not. So the other alternative is 110% of your prior year tax liability, and that's known as safe basis. So two approaches: current year 90%, prior year 110%. With that as background, let's go to the next slide and just discuss briefly when payments are due. So here you'll see the required annual payments must be paid in 4 equal installments unless you utilize what's referred to as the annualization installment method, which I'll talk about in a little bit later. But absent that, your payments must be paid in 4 equal installments in order to avoid a penalty. The installments are due normally 4/15, 6/15, 9/15 in January, the 15th of the following year, this year being different because for the April 15th first quarter payment is postponed until July the 15th. If any installment is paid late, the penalty is charged. There's a penalty that's charged beginning on the payment due date and ending on the date that you actually make the payment. It's referred to as a penalty, but it's actually an interest charge that's assessed at an underpayment rate that's established under the code provision, the 6621 section. And it's assessed for the the number of days that it's outstanding until you catch up and make the payment. There's a revenue ruling that comes out, I think it's quarterly, that identifies the interest rate for the upcoming quarter. The most recent revenue ruling was issued in February and identified the underpayment rate for the calendar quarter beginning April the 1st at 5%. I'm speculating that the rate may be lower for the quarter thereafter just because of what's been happening with interest rates. Before we get off of the slide, I guess I should make the point as well. This is federal that we're talking about. States could be different. Some states are, I'm sure, similarly structured with interest charges, but I do know that there are some states that actually have flat penalties, for example. So just be mindful that you need to think about your states a little bit different than you might be thinking about things on the federal side. So let's go to the next slide and just talk about different approaches to consider when you're making your estimated tax payments. All right, so again, when you're determining the amount of your estimated tax payments, you have 2 choices: prior year or current year. If you pay in based on your current year, you have two approaches that you could consider. One is the regular installment method, and one is the annualized installment method. So it's really those three choices that you have to consider. Prior year, 110%, 100% if your income's below those threshold. Current year, 90% following either the regular installment approach or the annualized installment approach. So let's just talk briefly about those two different approaches. Think of the regular installment method like this. You're confident that you have a strong estimate for where your overall tax liability is going to land as of the end of the year, and you just want to pay that in ratably throughout the year. So it doesn't matter what happens at any point in the year. If you think your liability is going to be X at the end of the year and you're confident in that, you can pay in based on that 90%, and a quarter of that would be due each quarter. That's when you're confident with where you think things are going to land by the end of the year. When you're not, you could consider relying on the annualized installment method. So think of that method like this. I don't really have any idea where my overall tax liability is going to be by the end of the year, but I know what's happened through the end of the quarter, and I'm just going to pay in my full tax liability for the income that I've earned and also for the deductions that I've incurred through the end of that quarter, right? So I don't know where things are going to be, but I know where things are as of today, and I'm going to just make a payment accordingly. So those are your options, and I guess a general question would be, well, where does that leave you this year if you have a normal income activity for the first quarter, but you expect to maybe have losses throughout the remainder of the year that might even fully offset the income that you've earned year to date? All right, so if you looked at making the payments under the regular installment method, you would say, I don't care that I have a lot of taxable income through the end of the first quarter. If I think my tax return is going to go on file with no tax due or some very lesser amount than what I've earned as of today, I can make my payment based on that today. So in an extreme example, if you thought you'd have losses and file a return with a net loss, you wouldn't need to make any tax payments by looking at this under the regular installment method. The risk is, though, that you're wrong, right? And you actually have a liability higher than that, and you should have had something paid in. You're not fully protected because you're estimating where things are going to be. Under the annualized installment method, it's almost the reverse. If you followed that approach and you had a lot of income this quarter, you might make a pretty significantly large payment. And that would protect you, but it also could put you in the position of being significantly overpaid if you ended up putting a return on file that had no balance due, right? Because that's ultimately the end game, right? Where things are at the end of the year. So I think the takeaway is maybe two takeaways. One is none of these methods may be perfect, but they're all options that are available to you, and trying to navigate your way through which provides you the best result as of any specific quarter is just an important thing to think through and work through. And then the other takeaway is what I mentioned at the bottom of the slide. You can actually alternate between these methods. If you're familiar with the Form 2210, and that's how you would calculate if you have any interest charges associated with underpayments, it'll actually pop out at the end whatever is the best answer for you, whatever is the lowest liability that would be due. Okay, so with that, Wendy, I think maybe we're shifting to our next poll.
That's right. So another true or false question. For estimated tax purposes, partnership income or loss is treated as received evenly throughout the year utilizing the annualized income installment method. And I should say this question is specifically for federal purposes. And while people are answering the poll, maybe Eddie, just to make sure we stay on track to get to all the speakers, why don't you just start to talk about some of the stimulus payments?
Yeah, okay, that's great. So just tell me when you want to shift back to the slides. I'll say the next slide you'll see is on the stimulus payments. There's a lot of details on the payment program, and I think mostly it'll be good takeaway for you to read after the fact. The biggest takeaway is largely that if your adjusted gross income is going to be above the threshold amounts, you're going to be fully phased out of receiving the payments. So if it's below, you can get a stimulus payment, obviously, but to the extent it's above, you'll be fully phased out. So you'll see the details on the slides that you can refer to at your leisure if you're interested in learning more about the program.
Yeah, and it may be relevant to certain family members, younger family members.
Children, absolutely. Mm-hmm. Yep.
That's right, that's right. All right, can we show the results? It's processing. Give it a sec. All right, well, let's keep moving forward. Let's talk about excess business loss limitations. Obviously, many clients are very interested in this provision that was applicable starting in 2018 and has been since revised.
Yep, so let's go to my first slide on excess business losses. So you may recall from the 2017 Act that excess business losses, EBELLs is what I'll refer to them as. So EBELLs, they were put in place under the 2017 Act. And just as a really brief refresher, EBELLs exist when your losses from trade or businesses exceed your income from trade or businesses plus a threshold amount. And the threshold amount was $500,000 for married filing joint, indexed for inflation. So if you had an excess business loss in 2018, it wasn't allowed, and in effect became a net operating loss that you carried forward to your 2019 tax year. Okay? So, well, what happened, right? The CARES Act postponed the effective date for the excess business loss provisions retroactively from tax years beginning after December the 31st of 2017 to tax years beginning after December the 31st of 2020. So that's right. The provision doesn't apply to the 2018 year, even though you have filed returns that may have created an excess business loss provision, an excess business loss carryover as part of that return. So the takeaway is, to the extent that you have a 2018 return, or I guess a 2019 return if you happen to file one already, that's been filed and reported an excess business loss, then you need to, and this you could be an individual, a trust, or an estate, you need to evaluate amending that return. We've already been given a great deal of thought to the implications of filing 2018 amended returns today if you had an excess business loss limitation that you now can, in essence, free up because the provision doesn't apply to that year anymore. Some of our concerns as we think through this, and this is as of today because it's clearly an evolving issue. There was even a comment from the government yesterday on this, but some of our concerns are we anticipate and hope to receive procedural guidance that really can provide a streamlined, simplified process for receiving the refund. And because of this, we really think it's important to wait for that guidance. As much as if you have this as an issue, you might want to file a return today, I think you'll find it to be helpful to wait for the guidance, because if you go down the path different than what the guidance actually indicates, it could take you down a path that just delays receiving that refund. And the comment I saw yesterday that the government made is actually recognizing we're working on this guidance and we expect it to be forthcoming soon. Okay, now if you happen to want to proceed without the procedural guidance, you would, and that wouldn't be something we would recommend, but to just cover that briefly, you would file an amended return for 2018 as opposed to any other form. You might think, well, maybe I could file a 1045, which is a quick refund claim. You couldn't do that because it needed to be filed by the end of 2019. And frankly, you're really only supposed to file those when you have carryback claims, and this isn't even necessarily a carryback claim. It could just be a full offset of some taxes that you paid in 2018. And the other thing you need to be aware of is that without procedural guidance, refunds of greater than $2 million, and that could be the case here because some of these loss limitations were very significant, refunds of greater than $2 million would need to go through joint committee approval. So each of those, filing an amended return, going through joint committee, really can delay the quickness that you would see those refund claims be issued. And that's why, like I said, we really recommend that we wait until we see that procedural guidance.
And Eddie, I just want to add one point. Yesterday, there was a revenue procedure that came out, I believe it's 2020-23, and it gave an alternative to partnerships to actually be able to amend their returns, not necessarily directly in line with the BBA rules, but it gave an alternative for amending 2018 and 2019 returns. And we, anticipate it may be a taxpayer, a partnership that may want to be able to accelerate a qualified improvement property deduction, something like that. And it gives a lot of flexibility. You really want to understand before you go amend for 461L, the 2018 return, could there be other partnership investments that could be amending too? So another reason to wait and understand.
Yep, and if we're going to get some similar type of flexibility, you'd hate to have pigeonholed yourself into a filing that now maybe you regret because you're not following the procedures for that flexibility. So let's give it a little bit of time. Hopefully within short order, we'll see something. I do have another slide on 461L, and I just want to cover this briefly, but this is going to cover an important point. I think to those of you that saw this, it's an important point for you to be aware of. So there's technical corrections that were built into the CARES Act as well. And the technical corrections that were created that apply to 461L are effective as if they were included in the TCJA, so the 2017 Act. So they're effective as if they were part of that legislation. And one of those is a correction that denies any deductions deductions, gross income, or gains attributable to any trade or business of performing services as an employee into the calculation. So that was a point of uncertainty and is now addressed, so that when this provision actually becomes effective again for years beginning after December the 31st of 2020, what that technical correction indicates is that wage income is not going to be included as business income for purposes of the excess business loss limitation. Okay, so now we know that for certain. Doesn't really affect what you did for 18 because it doesn't apply for 18, 19, and 20, but this technical correction is now part and parcel of the provision as if it was included in the initial legislation. With that, why don't we go to net operating losses sort of as a continued conversation associated with the excess business loss provision. So on this slide, you'll see the CARES Act established the ability to carry back net operating losses, okay? Providing that net operating losses generated in tax years beginning after 12/31/17 and before 1/1/20, so for calendar year 18, 19, and 20, those losses can be carried back to the preceding 5 taxable years. That would mean go back to 13, right, from 18 to 13 or 19 to 14, right? Go back 5 years, use what you can use, and then carry it forward, right? And you'll work your way through that 5-year continuum. Under prior law, you basically weren't able to carry back NOLs. They had to be carried forward. Okay, now the other provision that the CARES Act addressed is it suspended the income limitation for net operating losses that are generated in years after 12/31/17 and before 1/1/21. You may recall that there was an 80% limit for NOLs. That is gone for those 3 years. You can actually offset 100% of your income, although the 80% limit does come back for years beginning after December the 31st of 2020. So for those with the net operating losses, right, whether you create them from an excess business loss that you now can free up from 18 or 19, or you just have a net operating loss, the ability to carry them back for 5 years, as well as the removal of the 80% taxable income limitation, it just provides a nice opportunity to monetize the net operating losses. But just keep in mind, you can still waive the carryback and carry it forward, and that may prove to be a better result for you. I don't know. You need to model it out. It's an important decision, both from a tax perspective, but also from a non-tax perspective, just in terms of the need for cash. So modeling that carefully is important. With that, I was going to go.
I'm going to add, yeah, I just want to add one thing. So to the extent families still have operating companies or a direct interest in private equity, portfolio companies, really the interplay with, is there an ability to generate more losses with the 2019 return so that the owners, individuals, or trusts could have a loss that they could carry back will be very important. And then also when we think about, these rules also apply to C corporations, and we know that many family offices have been restructured to become C corps, and they may have a profits interest structure in place. So, it's really going to be important for the family office to do modeling to estimate its taxable income or a projected loss for 2020 when you think about whether or not it's going to receive the profits interest. And if it doesn't receive the profits interest and a net operating loss is created in 2020 at the C corp, the family office C corp, consideration will need to be given as to whether or not the family office chooses to carry back that 2020 net operating loss. You have to carry back 5 years, and if there's excess, you just keep then carrying it forward each year, or if they're going to elect to just carry it forward. So that's going to be important. And then also at the family office level, to the extent you're projecting net losses, there'll be a necessary interplay with then, how you think about making 2020 estimated tax payments, because we don't know what's going to happen with the markets, and in many cases the profits interest isn't crystallized till the end of the year, and so you may not know if you're ultimately going to get the profit interest. So really an ongoing dialogue between NOL rules and estimated payments for the family offices as well. Next slide.
So this is my last slide before we shift over to estate planning considerations. I'll just cover this briefly. So this provision, this is where the CARES Act eases the Section 163J provisions. And those provisions of the 2017 Act provided a limitation on the deductibility of trade or business interest expense. At a real high level, it basically limited it to 30% of your adjusted taxable income. The CARES Act made some changes. First, it increased the limitation for any taxable year beginning in 2019 or 2020. The limitation is increased from 30% to 50% of ATI, which makes it easier to avoid limitations, right? And that's helpful. Although for partnerships, the increase only applies to tax years beginning in 2020, and largely our view is that's because a lot of partnership returns were already on file, and increasing the limitation was just harder to manage through the system. They did make a different change for partnerships though. So since the limitation, the 2019 limitation remains at 30% for partnerships, the law provides that if a partner is allocated excess business interest expense, so expense that the partnership wasn't able to deduct for any taxable year beginning in 2019, right? So you get a kick out of excess business interest expense in 2019 from a partnership. 1/2 of that amount is going to be deductible by the partner in 2020 without regard to the 163J limitation. The other half runs through the normal limitations that you would be familiar with from prior years. And then also for any taxable year beginning in 2020, an election can be made to use the 2019 ATI in lieu of your 2020 ATI, which is helpful, obviously, if the ATI is lower in 2020 than 2019. So with that, Wendy, unless you have any other comments on this, I would say.
Yeah. I think the biggest place that family offices should consider this is to the extent possibly that there's a family investment partnership with private equity investments where maybe there's been a limitation of excess business interest expense, really looking at your 2019 numbers once they're finalized in the September 5th timeframe and looking to see how much additional interest expense could be allowed will be relevant to the family. So with that, we'll turn it over to Washington National Tax Partner Craig Janes, who leads our estate and gift practice. Thanks, Eddie.
Greetings, folks. Glad you could join us today, and we'll move through this relatively quickly. It's hard to imagine that there might be a silver lining to the current crisis, but when we talk about transfer taxes, there might just be. The basis of the silver lining is the correction in the securities market that's occurred in the last 4 weeks or so. Remember, the basis for the transfer tax is the value of the assets transferred. So as a consequence, with the market correction and with respect to obviously transferring marketable securities, those values are now suppressed. Although I believe everyone is anticipating a rebound at some point, taking advantage of the current suppressed value might be the silver lining to the current crisis. It expands more than just gifts of marketable securities, though. Basically, any asset that is valued with respect to the securities markets is going to have incurred a reduced value, even though the underlying economics of the company may not have changed. And so, again, an operating company that is normally valued using guideline public companies, for example, even though the underlying economics haven't changed, the value of an interest in that company is going to be less. As a consequence, excellent candidates for considering for transfers would be gifts in closely held businesses and closely held holding companies, including interest in closely held investment companies. Particular concentration should be given in perhaps looking at making gifts of minority interests in these entities. The reason why minority interest in part is valued by reference to discounts for lack of marketability. And these discounts are in part determined by reference to volatility in the equity markets at large. Since 2004, this has kind of been codified in what's called the VIX index. And 9 of the 10 highest VIX index readings in the history of the VIX index have occurred in the last 30 days, and that includes the volatility we saw in 2008 and 2009, including the highest reading in the VIX index has occurred in the last 30 days. There's a direct correlation between the VIX index and the depth of marketability discounts that can be demonstrated empirically, and as a consequence, minority discounts for lack of marketability related to minority interests are now larger than they have historically been. As a consequence, when considering transferring a minority interest, there are 2 issues to take into account. Not only how does the overall decline in the equity markets affect the value of the company as an enterprise, but also how does the heightened marketability discount affect the value of a transfer of any minority interest in that entity. So again, keep that in mind. The second reason to consider making gifts now is one you've probably heard incessantly for the last 2 years, and that is that the 2017 Tax Act enhanced the applicable exclusion amount for every taxpayer. The applicable exclusion amount is the amount that you, as a taxpayer, can transfer without incurring a current gift tax. For 2020, that is $11.58 million per individual. That is indexed for inflation. However, that provision is intended to sunset January 1st of 2026, and it will be roughly cut in half. It is a use or lose proposition. So again, we've been encouraging people for the last 2 years to think about making gifts to utilize their enhanced exclusion amount. We would renew that observation, particularly now, since the value of what's being transferred has been relatively reduced, and again can be used to use your applicable exclusion amount. One of the concerns I've had a number of clients express to me is the last point on this slide, and that is, I have need of cash. The only way to generate it is to have myself redeemed out of a family entity. I don't want to do that at these depressed prices. Well, I would suggest that if it's truly a family-owned enterprise, that perhaps this is the exact time to consider having a senior family member redeemed out. The reason why is when the recovery occurs, the senior family member has exited stage left, then the rebound in values is going to benefit younger generations of the family rather than having the value of the senior family member's interest rebound. So I think instead of looking at getting out in a reduced market or value situation, perhaps that's exactly what you should embrace if the circumstances are right for you. Let's go to the next slide. With every downturn comes the inevitable rebound. I think one of the things people forget is that business opportunities or transferring business opportunities or investment opportunities to family members isn't a gift. And actually was tried in the courts back in the early 30s. What I encourage people to think about is, even though senior family members have had a setback in the valuation of their estates and are looking forward to perhaps recouping that, maybe they shouldn't be making or taking advantage of current investment opportunities. Maybe they ought to be moving those opportunities to trusts for family members and helping those trusts or younger family members finance the investment by either loaning the money or somehow playing the bank. Again, the point here is the estate tax is still there, still not going away, and again, any suppression of the growth of the estate for senior family members is actually a good thing so long as the wealth remains within the family. So again, moving opportunities as they come along during the recovery is something you should consider. The second point is also important. Not only do we see market corrections for equities, we see market corrections for the interest markets as well. Just to keep things in perspective, we've had the applicable federal rate since 1984. The estate tax expression of that rate is the 75/20 rate. 75/20 rate was 1.2% in April. It's adjusted monthly. April is 1.2%. The lowest that index has been in the last 34 years, or 36 years, is 1%. That was back in 2009. And if it were recomputed today, it would be about 0.8%. As a consequence, when we're talking about playing the bank, the applicable federal rate is what you're looking at as your interest rate again, it can be a very opportune time to consider using loans as a vehicle to allow others to invest in again, investment opportunities. So let's go to the next slide. For existing debt, there's going to be a temptation because of falling rates to refinance that debt at the lower rates. I'd say be careful there. If the only thing you're trying to do is provide a benefit to the borrower at the expense of the lender, that doesn't take a great deal of imagination to characterize that giveaway, if you will, as a gift. As a consequence, if your notes are not currently in default or not likely to be in default, then special considerations need to be taken into account in doing those refinancings. It's not that they can't be done, but they need to be done carefully. It is an item that the IRS pursues, and so one must be careful in refinancing existing debt to lower rates. Interest rates are also drive many estate planning techniques, such as grantor retained annuity trusts and sales transactions, particularly sales to grantor trusts. These are nothing wrong, particularly with dealing with these types of transactions during low interest rate environments. That's when they operate best. But I would say both of these transactions don't use up a lot of applicable exclusion amount. And so if I were to put in a hierarchy what one we ought to be considering as one makes gifts, it would be use up your applicable exclusion amount, because I mentioned earlier it's a use or lose proposition. If you don't use it by January 1st of 2026, or if the laws somehow change between now and January 1st of 2026, it will be lost to you forever. Use it first, and then once you've utilized that, then the perfect candidate for additional wealth transfer would be something like a grantor retained annuity trust or a sale of assets to a grantor trust. And with that, I think we can jump to our poll.
Perfect. Thank you,
Wendy,
Craig.
on the next slide.
Thank you. So our question is, what wealth transfer approach, if any, are you most likely to focus on given the current economic environment? And that should pop up here in a second. And Craig, while we're waiting for that to come up, we saw many clients making gifts in 2018 and 2019 to take advantage of the increased lifetime exemption you mentioned. Is there anything that taxpayers should consider with respect to the gifts that were made in 2018 and 19, given the low environment that we're now in?
I've had several clients basically call up with the planning remorse. Gee, if I'd known this was going to happen, I wouldn't have done anything in the fourth quarter of 2019. I would have waited. Is there anything that can be done? And the answer is yes, there is. If the conditions are met, the donee can engage in a disclaimer, which would basically say, I'm not interested in this gift, thank you very much, and it results in a handback to the donor. That has to be done, though, in writing within 9 months of the date of the receipt of the gift. So, again, if other conditions are met, then perhaps that is a way to get a chance, a second bite at the apple at lower asset values. I'd be careful there, though, because I don't think, if just redoing it the same way could very much be viewed as a step transaction. So I would say doing new gifts, if there is a disclaimer being contemplated that doing the exact same structure, but just in 2020, has some difficulties associated with it. If you're past the 9 months, then it's really state law driven. Some states have relatively benign rescission provisions that would allow you to perhaps undo a transaction if there was a mistake, or if there was a common common interests between donor and donee that would apply under the state's laws. That again is much more legally driven proposition, and care would have to be taken there. But rescissions have been regarded by states and have been supported even years after the fact in the tax court if it's in compliance with state law. So yes, there are things to do if you're looking at donor's remorse, if you will.
Okay, great. We've got our results you can see up here. So it looks like Gratz are winning. All right, so with that, thank you very much for the updates, Craig. I'm now going to turn it over to Jane Searing, a Managing Director who leads our National Center of Excellence for Philanthropy. Jane?
Great, thank you, Wendy, and thank you, Craig. So I'm going to continue on Craig's silver linings of that, this is a terrible thing that's happened to our nation, actually to the world with this virus, but on the silver linings, people are reaching out and wanting to respond with a philanthropic response. And when you look at family offices, what I've said is that you've met one family office, you've met exactly one family office. And so sort of looking at you, the family office, you have to look at, well, what are your resources? What do you have? So when you look at a family office response to the COVID-19 crisis, you have to first assess, what do you have and what do you look like and what are your resources? And family offices are really comprised of the people. There's the principals, the owners, and who's in your family office, and that really depends upon the structure of your family office. And some of them are very highly centralized, where all the people are in one of the entities, and some of them are very dispersed. So they're individual businesses, and they have operating businesses. So you really have to look at where do the people lie, where are the talents, and where are they? And then there's the assets. Sometimes there's, lots of investment assets, there's cash, there's, so you have to look at what do you have as far as what do you want to contribute? Do you want to donate your people? Do you want to, what is inside of that family office? Some family offices, again, have those operating businesses. There can be film companies, there can be aircraft, there can be all kinds of different resources that can be deployed, and you have to sort of step back and say, well, what are we best equipped to contribute to? What are the needs in our community? And then, from that standpoint, within those entities, each is unique and have different resources that they can deploy. So when you think about what you are suited to, some are very, involved in the supply chain. So, understanding where you are and where you sit within your community, and your community can be defined, very locally, or it can be at a national scale or even worldwide. And then, looking at that fourth column here, the timeline, some are, we have some clients we work with that are very, the impatient optimist, they want to look at, what's the first, they want to be the first to deploy, and they're very, they're ready to deploy immediately. And then there are some that are, they sit back, they evaluate, and they're looking at that long-term, want to be able to thoughtfully say, well, we're going to look at, as we start to come out of the thawing of what's happening, because we've put our economy on ice, how will we deploy resources either in loan funds, or other resources. So, that last step is, what's the timeline? How do we want to deploy long-term? So that can look like investments. So why don't we look at next slide, how, what has the federal government done to respond? So the CARES Act was, we had the federal government passed some new laws that were actually aimed at pulling the levers. I mean, that's one of the things tax law does. The policy decisions that are pulling levers to incentivize taxpayers to act. So one was aimed at corporations, businesses, the others at individuals, and then One of the provisions of the Code Section 170, it just says you look at the partnerships and S-corps, and there's a section that just says you look through to the individual partners and shareholders. You look through to who's actually in those entities. So whether they're corporations or individuals, you look through. The corporate provision basically raises the deduction limit from 10% up to 25%. It has to be, the provision is saying it's only for 2020 and it's cash. So it's cash out to public charities, and it is, public charities are defined as 501c3s, but not to donor advised funds and not to supporting organizations. And supporting organizations are just a subcategory of public charities. It also does apply to your private foundations if they're able to make a conduit election. And what a conduit election is if they can redistribute the funds by the close of the following tax year plus 2 months and 15 days. And if you have questions about that, we can certainly help you with that. It's a special election that you can make from a private foundation. But basically, it's a pass-through out, and they have to make, redistribute the funds. For individuals, there's two different provisions for increased contributions. The first one is very helpful in a lot of, even for, kids or, people that don't itemize. It's basically an above the line. So at arriving at adjusted gross income, any taxpayer can contribute $300 in cash and be able to reduce their taxable income by $300 when they make a contribution to a public charity. Again, the definition is the same. And that's, what they're hoping is that will stimulate the contributions of contributions. And then the second one is this increase, and it's a topping off provision so that it raises the adjusted gross income so that you can basically contribute up to 100% of your adjusted gross income. And again, that's cash contributions. So moving on to the next slide, this is looking at, well, how would individuals, how will they be able to contribute? And this is just looking at the high level overview of public charities, donor advised funds, and private foundations. That cash contribution up to 100% of the AGI limit, again, that's 2020. They're really looking at this year. Now, would they be able to, in subsequent tax laws, as they're talking about earlier, would they extend that beyond? Maybe. We don't really know what's going to happen, but this is for this year. There's a provision that allows for out-of-pocket expenses. That's the equivalent of a cash contribution, but you have to have that relationship with the charitable organization. So if your family office has a relationship with a public charity and they're acting on behalf of, and they have a volunteer relationship, you can get to that place where you're making cash contributions if you have volunteers working with that public charity. Again, work with your tax professionals to understand how that works. But sometimes if you have employees that are working with public charity, you can get there. Really important to have proper donor substantiation, getting those proper letters when you're making contributions. That's something where the IRS has won a lot of court cases where you have not had that. Donor advised funds, they are still very helpful. They're a great tool. If you already have one, you already know that. But we've had employers who have been setting up employee assistance funds with donor advised funds. They've been very useful in this particular crisis. There's an exception for donor advised funds when they have a singular purpose in response to a crisis like this. And the last is if you do have a private foundation, they've been actually quite helpful in this situation to respond to the crisis. And they are available for making that out of corpus election. If you do want to make a cash contribution to your private foundation, you're able to do that in this case. So moving on to the next slide with this business charity, I just really want to highlight the difference. You can't get to 100% with a corporate contribution, but it does go from 10% up to 25%. Really making sure that you're getting your donor substantiation letters properly done. And again, Normally, donor advised funds cannot make contributions to individuals, but with an employee assistance fund, that is an exception. But you can't get up to you can't get the increased benefit for making contributions to donor advised funds for the CARES Act provision. So being aware of that. But looking to the future, let's go to the next slide, because I want to make sure that we've got enough time for you to hear from Grace, because she's got some good comments that she wants to be able to share with you. Into the future, when we get beyond where we are right now and we start to move into where we're going to respond, private foundations have the ability to make program-related investments. And, you know, when foundations have the ability to do that, they can make loans, they can make investments that are primarily for charitable purposes. I think that we're going to anticipate that foundations are going to be doing that in response to this COVID, you know, when we're starting to see foundations invest in their communities. We're already seeing these disaster relief payments being made out of our businesses and through foundations for employees. And I think Grace is going to talk about this more. These are broad-based. They have to be non-discriminatory. As long as they're not wage replacement and they're not expected to be expenses reimbursed by insurance, these payments under 139 have been really helpful to people who have been harmed by this emergency. We are also seeing our family offices partnering with their local charities to provide relief, both short and long term. Some of the other vehicles, and this has been going on for a long time, the alternative to the private foundation, these social welfare organizations, which are the C4, they allow for lobbying activities and political activities. They are not C3s, but they are charitable in many cases, as well as being able to do these additional expanded activities in the lobbying and political activity spaces. And then we see the hybrid organizations that can be very charitable, but they are not actually tax exempt. So in some cases, the ones that are charitable can be medical research, the agricultural research organizations, those are C3s, but then the ones that are just true hybrid organizations, they're LLCs, they hold the money separate. And then when they do get ready to deploy for charitable purposes, then they can go into a C3, they can go into a C4. We're seeing lots of different ways that people are being very creative at how they're structuring their charitable activities out of the family office. So, you know, maybe this is putting a highlight on it because it's acute, but I think long-term family offices are starting to set up a whole charitable sector within their family office structure. So maybe that's one of the silver linings we're going to see from all of this. So in response to that, why don't we go ahead and we'll do our polling question, and then we will move to Grace as our last presenter.
Great. Thank you, Jane. So what philanthropic response is your family office most likely to deploy in the next 30 to 60 days? Well, the participants answer that question. Jane, if there's one key takeaway on philanthropy that these family office execs would want to take back to the family members, what would that be?
Well, maybe instead of one, can I give you three?
You can give me three.
I would say that first, I would say that they really do need to assess what their strengths are, what are their resources, what do they do. They need to take an inventory of what they have, and then decide what their time horizon is going to be. Are they going to be immediate responders? And, you know, what is their, how do they want to respond, and then match those things up. And then, you know, I really would encourage them to be collaborative and learn what's going on. You know, the most recent thing that I can see, you know, what I saw a really good response was in Flint, Michigan, when they had their water crisis. You know, funders came together and they learned from each other, and they didn't overlap and duplicate efforts. And they had a really good response to that. And so I think that this is similar to that in some ways, in that when you learn from each other and don't overlap and collaborate, you can have really positive outcomes. So I guess, you know, inventory, time horizon, and be collaborative and learn, you can do a lot together. So that would be my suggestion.
Thank you, Jane.
Thank you.
Appreciate the overview. I'm going to now hand it over to Grace Melton, a Washington National Tax Partner within our Global Employer Services practice, to talk about a variety of the employment tax updates. Grace?
Great. Thank you, Wendy. So I want to spend just a few minutes talking about some of the recent legislation, including the CARES Act, but starting first with a very important provision that came out of the Families First Coronavirus Response Act, and that's what's referred to as HR 6201. And then also I'll cover off 3 areas for the CARES Act that you see here, basically some advanced refunding of credits, the employee retention credit that people are very interested in, and then also the delay of payments of employer payroll taxes. So with that, we'll go ahead and dive right in. And I won't spend a lot of time with this first slide, HR 6201, but I did want to make note that the payroll tax credits that are allowed under that Families First Coronavirus Act basically apply only to employers that are subject to mandates for paid family leave and paid sick leave requirements. So the credit availability merely follows an employer who's actually required to pay those sick leave and family leave wages to individuals. And it's interesting because the payroll credit, of course, in maybe advance so everyone can see here, the payroll credit it follows merely the wages that an employer is required to pay. And of course, that's a tax item. However, the mandate itself for the wages to be paid is based on labor law. And so it's very important for companies to work with their legal counsel to make sure that they understand whether or not they are subject to the paid leave and family leave mandated wage provisions of HR 6201. And just to say it, because I think there's been quite a bit of confusion out there, for private sector companies, whether private or publicly held, it basically applies to companies with less than 500 employees. But the key is how you count those employees, whether on an aggregated or an affiliated basis, and all of that is, again, based on labor law. So it's very important to make sure that employers understand if they're subject to those requirements or not. So with that, we'll go ahead and move on to another provision under the CARES Act that actually addresses this payroll credit for the payment of family and sick leave wages. And basically, for the CARES Act, a new provision was introduced, 3606, and all that provides is that if you anticipate paying the family and sick leave, those qualified wages, and you anticipate payroll credits based on that, you're able to take basically an advance benefit of that credit on a quarterly basis. And this in particular provides relief to employers who are making deposits based on that expectation, so that you are not then subject to penalties for failure to deposit payroll taxes on a timely basis. This also just applies to the employer Social Security portion of the tax that the employer would pay, which is the 6.2%, and it does not apply to the 1.45 Medicare piece for employers. And I would encourage people to definitely monitor the release of forms and instructions by the IRS as new things are coming out almost every day. There's also a recent notice that we don't have included here. It's Notice 2020-22, and it actually provides even more broad relief to employers who are taking advantage of not only this payroll credit for the mandated sick and family leave wages, but also the retention credit. So definitely stay tuned on information that's coming out. So we'll turn to the first slide that we have here on the retention credit. And there's basically 4 things to think about for the retention credit itself. You have to determine who is an eligible employer. Then we determine who is paying qualified wages as defined under the retention credit, and then also calculate the amount of the credit and then claiming the credit. And you know, the title here is Employee Retention Credit for Employers Subject to Closure Due to COVID-19, but it's really important to remember that this does not require an actual closure of all of the business. It can be just a partial decline in the business gross receipts or a partial suspension of operations. So we'll go to the next slide just in terms of who is an eligible employer, and this will kind of come to life more here.
Excuse me, sorry, so Grace, I'm going to interrupt. Let's go to the next slide after this, please. Thank you.
Great. Thank you so much. I appreciate that. So with an eligible employer, there's a few things to keep in mind. An eligible employer is an employer that is in a trade or a business. And so that's a key fact here in applying this credit itself. And so, you know, in certain cases, companies on this call or individuals on this call might be paying wages, but the key here is the determination that it's a trade or a business. So once we get to that point, then we look at the two tests that can be applied in terms of whether or not you are an eligible employer. One is that you've had a full or a partial suspension of operations due to a government order, or, and this is a very important or, you have experienced a significant decline in your business, and that's based on a gross receipts test. Basically, a decline would be where you have a gross receipts of the business in a given quarter that are less than 50% of receipts from the same calendar quarter from the prior year. So you're looking at a year-over-year test, and then you remain eligible until essentially your business has popped back up to a certain level. It's a 80% threshold. And there's some nuances with that, but for this call, we'll not get into sort of the technical points in terms of that period, but that's the baseline. It is important to note that these tests are applied on the controlled group basis based on tax rules. And that's an important distinction. One of the reasons why is that employers who take advantage of the Paycheck Protection Program under the CARES Act and who receive an SBA loan no longer are eligible for the retention credit once they receive that loan. And those rules, of course, for who's eligible for that Paycheck Protection Program and to receive a small business loan are based on non-tax rules. Those are based on different affiliated group rules. So very important to be talking with your legal counsel and others about just those rules if you are contemplating taking an SBA loan. So we'll go on to the next slide. Just talking about qualified wages, really the intent of this is, again, it's a retention credit. So it's meant to provide credit, the incentive to employers who are keeping people on their payroll, essentially, or providing health care, even though that person's not providing full amount of services. So there's two tests in terms of determining qualified wages. We first have to figure out if we have more than 100 or less than 100 employees as that trade or business, that entity. And again, these are based on tax rules. And so you look to sort of our normal rules in terms of defining control group based on Code Section 52 and certain provisions of 414. And I'm sure everybody on this call is very familiar with some of those rules because you're already using those rules for other tax purposes, or for instance, in administering your 401k plans. So for entities with more than 100 employees, we're looking at wages paid to employees who are not providing services. And that's really the key for that group of that company that has over 100 employees. It's the not providing services part, and it's very facts and circumstances based as to when someone is and when they're not providing services. And it really takes looking at each element of the wages. For those entities with less than 100 or fewer employees, it's basically all wages that are provided for the covered period, so the time that you are significantly impaired because of the COVID based on the two tests that I mentioned earlier in the call. There's also a provision that if you meet one of these tests as an eligible employer, in addition to the qualified wages that you're paying, you can actually add to the amount of your qualified wages anything that you might provide to the individual to continue health care coverage. So if you have a health plan, you're making your contribution as long as that amount would be otherwise excluded from the gross income of the individual. So when we look through, all of the tests of who's an eligible employer, then what wages do I get to count, we sum all of that up, and the qualified wages are limited to $10,000 per person. And then the credit, if we want to flip to the next slide, is based on 50% of those wages. So net sum game, our per person per year credit for a qualifying person here would be $5,000. And that's something, again, that many clients are very interested in.
I'm going to interrupt here. I'm going to ask to actually to put up the poll just to make sure everybody gets the last poll up, and then we can keep highlighting that. So Lil, if you can move to the poll, please. What employment tax provisions in recent legislation are of most interest to you? And I just want to highlight, based on the conversations I've had with you, Grace, when we talk about determining if a company is an eligible employer, if a state has basically issued a stay-at-home order, how do we think about that? And because many of the family offices may have less than 100 employees.
Right. Yeah. So one of the tests was that the company has had a full or partial suspension of their business due to a government order. And it's not explicit that that has to be a direct order to that individual, but it also could be where they are, that company is actually impacted by an order. And so you really do have to look at the facts and circumstances. An easy case would be where you have a supplier that has impacted you, and that supplier is directly impacted by a government order, and so that therefore has an impact on your business. But there is an application there as well for where there's a significant population that otherwise is under some order, like a stay-at-home order, that is impacting your business as well.
Great. Thank you, Grace. Okay.
Okay.
All right. We'll just keep
In
moving.
the interest of time, go
Yep.
ahead. Okay.
Yep.
So the last part here, just to finish off on the credit piece of it is, and this is the one where I say stay tuned because there's a lot of information coming out from the IRS. So the IRS has put out some information that I think is very helpful. Basically, for this retention credit and also the payroll credit for the paid and family leave sick wages that I started out with, those can actually be taken into account in the quarter, as I mentioned earlier. This credit for the retention credit itself is claimed on a quarterly basis, and it applies to the employer portion of Social Security. It's the 6.2%. And then that, if you have any excess credit left, it's refundable. You can also apply it against other deposits that you might have for the quarter. So say your employer portion of Medicare tax, the 1.45%, it can be applied against the employee share of both Social Security and Medicare taxes and federal income tax. And so what that does essentially is each quarter it allows you to, instead of depositing cash, to use any excess credit that you have from the retention credit in order to really benefit you from a cash flow perspective. And then after that, if you still had additional amount of credit, you could actually get a refund as well by filing a Form 7200. So again, all of this is sort of being worked out now in terms of the mechanics, but do note that the 7200 is available for this advanced crediting. For the refund, and then also all of this is going to go through for first quarter and second quarter, the Form 941 that employers file for their payroll taxes. Let's see, just moving on, I just want to hit this one last one and then we'll close out. And it's very important. This is the delay of payment of employer payroll taxes. And again, this is the employer portion of Social Security, that's 6.2%. There's a provision, and this is applicable for companies of any size, that there's an ability to defer those taxes that are due for 2020. 50% could be paid by December 31, 2021, and the remaining 50% due December 31, 2022. It is very important to consider a couple of things. One, how your other credits are going to work throughout 2020 in determining what your liability will be for those Social Security taxes. And then very importantly, if again an employer is participating in the Paycheck Protection Program under the CARES Act and receives an SBA loan in connection with that program, at the point in time any loan is forgiven that has been received, the deferral until 2021 and 2022 will no longer apply. And so again, recap, once you have the loan and if it's forgiven, the delay ends at that point. So Wendy, with that, I'll turn it back over to you. I know we went through that quickly, but hopefully maybe we'll get some questions and we can follow up on those with individuals later as well.
Absolutely, we're happy to help. One final, we're gonna go slightly over, but I wanna make sure David can share. We know that not every family office has an internal tax department, but many do. And because of privacy concerns, many of the employees on your teams have not historically worked from home. And so given that the family still expects the same level of service, we could see family offices have needed to quickly pivot to learn how to work remotely and manage all of the tax obligations for the family to avoid a miss. David, I'm going to turn over to you to talk about this in a little bit more detail.
Sounds great. I appreciate that, Wendy. As Wendy points out, right now with everyone working from home or significant portions working from home, a lot of our clients' technology infrastructures weren't set up to support this completely remote workforce. And as Wendy points out, even if the technology is there, the business processes might not be there. And especially as this group of the family offices serves so many different types of taxpayers, from entities, trusts, individuals, foundations, it just increases that complexity. So if your teams are struggling with this new situation, the first thing to do is really identify what are those keep the lights on items that must keep moving, and what documents or data, what are those critical things needed to keep that moving. And then do you have a business process? Is there something you can use in place that can help to move the business process forward? Things that naturally happen when you're all sitting in the same place that now have to take a concerted effort, like a notification that this process is done, it's ready to review, et cetera. And this is where technology can play a vital role, especially a cloud-based collaboration platform that allows you to share documents and business process workflows, things to keep the work moving. But if you didn't already have that, how would you go about doing that now? And not only now, but do it rapidly. So getting access to one of these cloud environments is generally the first step, and maybe as easy as a simple link to an invitation that then sets up a multi-factor authentication, so you've got a secure access site. And then depending on your current ability to access internal systems and documents, the next step may vary based on your office. For example, we had one client who sent one person back into the office to load a number of documents off of their local LAN or shared drive onto one of these cloud collaboration platforms. That's one option. Once they're there, then doing quick video trainings, getting your people educated on how to use a platform like this and start to use it to move work forward. So just wanted to take a couple of minutes, know we're running over, to introduce that. If your group is having struggles here, Deloitte has technology people that can help and consult and give you options. So please reach out if this is something that your group is struggling with. Wendy, thank you.
Great, thanks, David. And this now concludes our webcast. Unfortunately, we couldn't get to all the questions that were submitted, but we will follow up with each inquiry in the next few days. We'll also be sending a follow-up email with a link to today's recording and a feedback survey that we'd truly appreciate if you would fill out so we can learn how we can better serve you or address the questions that you're having. Thank you again for your attentiveness. Please call us or email us if you have any questions at all. Have a good day.